Demand for the US dollar continues to pick up steam as the US dollar index jumped above the 106 level today, reaching highs not seen since 2002. Today's US dollar buying pressure coincides with increasing demands for treasuries and decreasing demands for stocks. The 10-year Treasury yield has hit 2.81% intraday, while the Dow Jones Industrial Average has dropped 700 points in intraday. Many traders may be wondering how long this bullishness will last for US dollar and whether it's still worth hopping on the bandwagon. Will the Federal Reserve continue its recent historic descent into hawkishness, or will rate hikes and US price increases subside? This leads us into the key question that ought to be explored. Just how bad is US inflation? Whenever discourse about inflation involves specific inflation rates, such as the 1% month-over-month US inflation recorded in May, we are not actually referencing inflation itself, per se. This is because real inflation is quite nebulous. Markets are extremely complex and organic by design, rendering a perfect gauging of price increases within a whole country practically impossible. This explains why there are so many measurements of inflation, such as consumer price index, personal consumption expenditures, price index, producer price index, and more, because there is no such measurement that is completely reliable. This is helpful to consider when addressing the shortcomings of CPI, widely considered to be a proxy for inflation. CPI in the US, recorded by the Bureau of Labor Statistics, is why we say that annual inflation recently hit 8.6% and hovers at 40-year highs. However, many are unaware that the way the BLS calculated CPI changed in 1983. According to The Economist, writing about research conducted by Marhin Bolhuis, Judd Kramer, and Larry Summers, CPI changes made in light of housing market volatility have distorted historical U.S. inflation data. Apparently, adjusting for these changes in calculation, the stagflation of the 1980s is significantly closer to today's inflation highs than historical charts reflect. Unfortunately, this means that today's hyperinflation is likely even more significant than is recognized. Considering how contemporary hyperinflation in the US is closer to historical highs than current CPI data indicates, this presents the Federal Reserve with an even tougher challenge than previously thought. While the Fed has recently shown that they are willing to resort to unusually big hikes in eager attempts to slow down hyperinflation, the current federal funds rate has still not even reached 2% yet. By contrast, the stagflation encountered in the late 1970s and early 1980s warranted a far more severe response from the Federal Reserve, with a target interest rate frequently hovering in the double digits, even hitting 20% in 1980. While today's Federal Reserve is likewise pursuing a tighter monetary policy, these two variations of hawkishness are apples and oranges. A 2% interest rate is a far cry from 20%, no matter how you try and justify it, and considering that rate hikes are still the Fed's primary tool for stopping a hyperinflation problem that more and more closely resembles that of decades past, the cooling effort may have just only begun. While today's inflation debacle is currently not identical to that of 40 years ago, with such variables as significantly higher levels of consumer, business, and government debt possibly increasing rate hike effectiveness, they are far from being dissimilar. Another significant factor contributing to persisting hyperinflation in the U.S. is globalization. This is because of the frequency with which the U.S. economy indulges in gigantic trade deficits, relying on international supply for the sake of ostensibly cheaper goods, services, and labor. These supposed benefits can exacerbate higher prices in the U.S. when hyperinflation is a global problem, as it is today. The Federal Reserve may be able to create lower demand within the U.S., indirectly generating lower prices and slower price increases, but their influence over rising import costs is lesser. For example, while the surging value of the U.S. dollar against other currencies has thus far protected U.S. consumers from the full brunt of import price increases, global supply chain issues have nonetheless left the U.S. vulnerable to sharp rises in food and energy prices. These are particularly difficult dimensions of inflation for the Federal Reserve to contend with, since Chairman Jerome Powell cannot hope to finagle monetary policy to increase gas or grain supply or soften Putin's heart. These worldwide supply problems will mean more Fed hawkishness, not less, as these near ubiquitous conditions dull the effect of rate hikes in the US. The US dollar's bullish run likely won't last forever. Even in 1985, just after the DXY peaked above the 160 level, price action began to plummet all the way down to the 85 support zone by 1987. However, considering that the global economy is still deep in the throes of supply crisis, wartime concerns, and corresponding sanctions, and the after effects of unprecedented emergency expansionary monetary policy, the hyperinflation problem is likely far from resolved. Considering that US dollar continued to soar with inflation in the late 70s and early 80s, in spite of increasing unemployment and periodic contradictions in GDP, there seems to be a higher probability that US dollar and US inflation will continue to climb into the near future. Now, some key takeaways. The US dollar continues to gain strength, reaching DXY highs not seen for 20 years. Current inflation metrics for the US, such as CPI and core PCE price index, may paint an inaccurate picture of US inflation, as real inflation appears to be significantly worse. Though US economic conditions are not identical to those 40 years ago, the last time inflation of this magnitude existed, the Federal Reserve needed to resort to double-digit interest rates to cool the economy, a far cry from the current target rate of 1.75%. The effects of globalization on the US economy means that the prices in the US are also subject to global inflation and supply chain problems, which could likely necessitate additional hawkishness from the Federal Reserve. Considering the severity of hyperinflation, both in the US and around the world, seems to be a good chance that the US dollar's bullishness momentum will continue in conjunction. Now let's shift gears a little bit and talk about the US dollar and the upcoming NFP report. The US dollar had a great start to the week in the first couple trading sessions. With NFP and unemployment numbers coming out this Friday, volatility and speculation around the US dollar will increase as investors look to price in the unexpected. The first set of heavy news starts tomorrow with the Fed's meeting and the JOLTS job openings. This indicator will let us know how many job openings there were in the month of June. A higher number of openings means that the companies are looking to hire. JOLTS will also give us some insight on what to look for on Friday with non-farm payroll. If there are more job openings than expected, it could be an indication that more workers were added to the labor force. Higher NFP. However, job openings have not really reflected the number of people hired over time. The visuals show a fall in the number of jobs added, but a rise in the number of jobs opening. Although expectations are getting beat, the NFP has still fallen the past 4 months, suggesting a slow in economic growth. An expectation of hurting economy from high CPI, lower consumer spending, less jobs added, etc. is why the dollar is higher today. Investors are likely trying to price all of this in before the news on Friday. Therefore, it could be beneficial to start looking for long setups on the US dollar. Now let's take a look at some dollar setups. USD CAD. The US dollar finds strength above riskier assets and takes this pair to the top of the trend line in a triple top. Investors eye Friday's NFP report while expectations are much lower than last month's actual. Price could break higher as the third test on high suggests hard bullish momentum, especially from today's heavy green candle. If price can close above this channel, the next major level of resistance lies around 1.32. Aussie dollar. The Aussie dollar is on a steady downwards trend, which started about a month ago thanks to depleting risk appetites. Price has recently moved higher on the day, which means it could be setting up to test that resistance around 0.68308. The lower low suggests the trend will likely continue to the downside. Dollar Swiss. The dollar Swiss pair looks to be nearing resistance on the 4-hour after crossing to a lower low. The pair is trending in a falling channel with huge price swings in the meantime. However, it does look like price could complete the move above 1 before hitting the top of the channel and reverting back to the downside. Support lies in the 61.8% fib level.